Hello and welcome to week number 18, starting off by having a look at what happened on Friday. We saw a bit of a turnaround in some Chinese stocks, which caused a little bit of uproar in USDCAD as well. Basically, what the Chinese government, or Xi said, he said they want to bolster the economy. They're on track to have growth. That's why you see a bit of a reversal midday on Friday on a lot of assets. Economists believe that there's not a lot behind it, so there's some positive momentum and talk, but we're not exactly sure how it will work out. So you can expect some of these moves to get rendered clear. That also means that the rejecting moves you saw on Friday from GBP USD or Euro USD are technically all been driven by that Chinese, by this Chinese comment, and they are susceptible to fail. So that's something you need to keep in mind as we're moving into the next week. But overall, the entire movement was driven by something that is causing a lot of demand, and that's a lot of demand for USD, and that is something you don't find discussed quite a lot. So there's a market called currency basis swap. And if you don't know what it is, look it up. It's quite an interesting thing. And the very basic of it, currency basis swap is, for instance, if you are in, let's say, London, right? So you're in the UK. For talking sake, because we mostly talk about euro, let's say you're sitting somewhere in Frankfurt, Germany, and you're sitting on euros, right? So let's say you've got euros and you want to obtain some dollars to USDs to invest in the United States, or maybe you want to buy bonds, but you don't want to use the normal channel. You don't want to sell euro, buy USD, and then buy bonds. You want to use interbank rates, which is accessible to you if you're a wealthy individual. So there's a Euribor rate, 3-month rate, which you need to pay, for instance, whatever it is. Let's say it's 0.2, just for talking sake. And at the other end, it's going to be another figure as well, whatever it is. Let's just say it's 4, right? So it'd be basically, instead of sending money over to the United States, you just pay one rate and the other counterparty receives the other rate, which means money gets swapped around. You don't even need to have the let's say 1 million euros you want to convert it to get dollars. You want to get like $1,050,000 or something like that. And you'll be able to obtain that if you just every 3 months pay the rate, and that's the end of it. You don't even need to really necessarily have the principal in just now. It is more of it's a market which works on trust between banks and investors. So that's a cross-currency market, as easy as that. And one of the biggest one is the interest rate cross-currency market, and it's quite big. In general, the swap market is one of the biggest markets. Again, nobody talks about. Just to put things into figure, the US stock market is about 20 trillion, give or take. The US bond market, again, give or take, is about 40 trillion. But the currency swap market is north of $600 trillion worth of a market that you never see on your normal charts, anything like that. It's quite a very huge market. And you can easily say most of it is, or majority of it, I believe, is USD denominated. So it's a huge opportunity, huge market. And when we see rates move aggressively in the USD, we know there's a funding stress. So by now, you know these rates, if they move, they tell you how much they have to pay when they borrow. When these rates explode higher, that means investors or banks are happy to pay a premium to obtain those dollars. So why is that? Because there's a liquidity crisis maybe brewing, or maybe because there's just a USD shortage. You can more or less observe this if you look at Euribors. I mistyped that. Euribor. And this is something that does not matter unless we are in a situation where actually these spreads starting to kick off. So you can obviously see the futures contract for that. I'm going to look at the December one because these always tend to make a bit more sense to me. The latest print was, apologies, I'm looking at the wrong one here. So your Euribor futures and your 3-month Euribor futures, that's what we're interested in. And we are looking at the December note, which is trading at, which was trading about these levels, closing on Friday. I'm going to go into a bigger time frame just to you really capture the mood of how important these markets are in general and how they tend to move also Euro USD. General terms speaking, these Euribor futures obviously going up or down will determine the cost of obtaining euros or the cost of obtaining dollars. Usually what you see also in some spread charts, you might see them euro, and you can't do this on TradingView, where you see Euribor / OIS. That usually tells you where the funding stress is. And most recently, the funding stress has been moving up the way, which means obtaining dollars is much more expensive recently. And that seems to be driving, seems to be continuing in the meantime. And that is what's driving dollar demand right now. If that makes sense. So basically, it's the intermarket between the banks that's driving dollar demand. I don't want to expand too much on it. It's just general understanding is that there's huge dollar demand right now, and driving up USD prices because the liquidity in USD is getting scarce ahead of the Fed, which is expected mid-May to start drawing down about $98 billion of let basically their balance sheet run off, I should say. So that's the whole idea behind EURUSD coming down. Pretty much any other currency which is against USD, there's a huge demand for USD right now ahead of a big central bank shift. And in my view, there is no way of stopping this unless we see some seismic shifts. CFTC data most recently showed as well some euro longs closed their positions, but there's still some sizable euro long positions left over, which I think is still waiting to get drained out. That puts EURUSD in a very interesting spot because EURUSD really just claimed these levels, which was basically the COVID lows. It's difficult to say if it will move lower from here, but based on the factors that's driving it down from here already, it's hard to see where the bottom is in this currency. And I take it with a pinch of salt as we trade every day and every week. But the pressure for now continues to be down unless there's something shifting the market perception that the Fed might do things differently or the ECB will. But just to give you a real understanding, the size of the market that's moving USD right now is stupendous in what we've seen in recent years. So we've covered that. We're going to have a quick look at what the calendar holds for next week. We have 3 central bank meetings, and at the very end of this video, I'm going to show you a technique I use to trade out of drawdowns. It's not how you trade, it's how your psychology will work once you understand this technique. I will show you. So definitely stick around to the end of this video. It's going to be very helpful. Next week, we have 3 central bank meetings. One is the RBA, second is the Fed, and another one is the Bank of England. All of them are expected to come out hawkish, so it's very difficult to examine how market will trade. We also have bank holiday in the UK next week, Monday, so don't expect a lot of hot trading until US comes online with the ISM manufacturing data, which recently has seen some fluctuations. So ISM manufacturing PMIs are always closely watched to see how the manufacturing sector is faring. If you have to see it on the chart, you can see it's sort of topped out in April last year. Now we're April this year, 12 months later, and we are still above the all-important 50 level, so the boom and bust level, but certainly slowing. I showed a chart before, I think it was in February, which was quite important. So I'm going to show this again. So the PMIs get printed, and they tend to work in a sort of like a narrower range. So more or less, if I have to pick a top, sort of around north of 60 tends to be the top level, and south of 40 is sort of the bottoming level. And there's a lead and lag effect with the Canadian dollar, which is something I pointed out in February, and it worked beautifully until all of a sudden Canadian dollar started rallying unexpectedly and kind of blew this whole thing out. But Canadian dollar is in orange, and this blue line is PMIs. As Canadian dollar goes down, USDCAD will move up. And as we're sort of in a peaking environment for the PMIs, I'm expecting continued slowdown in the Canadian activities. That means more upside for USDCAD as we go ahead. And that's it, regardless of what the Bank of Canada does. I'm really expecting these levels to give away. So when we did this analysis, it was somewhere around, I'm on a weekly candle here, by the way, we were somewhere around these levels here in February. I was expecting USDCAD to move towards 130, take it confidently out. But because USDCAD is incredibly annoying, it did a 200 pip rally before dumping for no reason other than just liquidity surges, better part of 500 pips. So it's really difficult to obviously hold to a bullish view when you have these sort of movements. But from a macro perspective, nothing had changed. PMIs peaked, expecting USDCAD to continue crawling higher over the month, at least for the next 4 or 5 months. I'm expecting this to move higher. Levels I have in mind is about the 130 I'd like to get reclaimed, but any of these levels you can see on my charts, I really like to see them getting taken up for the as we move forward, unless again something from the economic side changes, but these movements are very, very slow to mature. Again, just to really visualize what happened in February, because we were really bullish, and then this kind of dump happened, and then it's just really regained it. The real move was always there. USDCAD, again, incredibly crazy sometimes, and it tests your patience. So this is about that. We're moving on in regards to what's left on the calendar. So post ISM, I'm expecting some nice movements. USDCAD, and mind you, Bank of Japan won't be active on Tuesday, Wednesday, Thursday. They will be all shut. I have to remember what it was for. It's not the golden holidays, is it? Bank will close observance of Greenery Day. Okay. First test of volatility we have is once the RBA comes out. So everybody's expecting the RBA to hike rates. It is questionable if they will. But having a quick look at this RBA tool I have here from the asx.com.au, it's basically a tool that tells you how much of a change is priced in. So market is now expecting an increase by 36% to 64% no change. If I were to show you the yield curve on that, I brought this chart up a few times before. Basically, this blue dotted line shows you what the policy rate is right now. These vertical columns show you where market is expecting rate to go to. It looks like market is a little bit overcooked here from what the current level is, because market is expecting an interest rate rise coming in May, which is next week, Tuesday. If for whatever reason that interest rate hike does not materialize, you can see a lot of disappointed bulls. If it does materialize, the next move will depend on what the guidance is. So if the RBA says we're going to be on a sustained path of hiking rates, because by the end of December, we'd like to have the rate by 2.5%, because that's what market is pricing in, then you can expect AUD to quite appreciate. If they don't give any joy to this 2.5%, which I think is very lofty, you can expect AUD to sell off, which seems to be a real risk going into Tuesday. At this point, it's not a trade for me because there's a lot of volatility kicking off into next week, a lot of central bank meetings and loads of cross flow, so it will be difficult to engage with that. But overall, market seems to be very lofty, expecting a 2.5% end of year yield by the interest rate by the RBA, and an initial increase as well as, I think, in my opinion, still a question. Loads of banks saying it's a done deal, but I don't see it that way. Again, there's more room for disappointment on AUD side than there is the other way around. Something to keep your mind on when we're trading. Tuesday morning, there's a pattern I trade around the RBA meeting or post the RBA meeting. That's something that I will discuss in the private trading room. It's a pattern that emerges on GBP AUD around the London fix. Again, some I discuss in the room, and if you'd like to, I'll show you a link how you can join in the end of the video. Going on the rest of the day, there's not a lot that will interest me. I'm not interested in any of these employment or quote-unquote changes, because the data points are only important when they influence the central bank. The Central Bank of New Zealand is on course to hike rates regardless, whatever happens to these data. They haven't came out yet to say anything, to say, look, if employment changes, we're going to change course. They didn't make it data dependent, their interest rate hikes. That's why we expect them to be on course. So these data points will just be a volatility puke, and possibly with NZD selling to weakness, sorry, selling to strength. And one of the trades I am interested in taking with regards to NZD is NZD JPY. And one of the reasons is that looks like PCE in the United States, or PCE growth, I should say, based on Friday data last week, has peaked. That could provide us with a small impetus for NZD JPY to start trading towards lower levels. So the levels I'm looking at, and ideally the reason why I'm interested in NZD JPY is because none of these currencies will have any central bank meetings next week. And it's sort of like it just analyze them, and you can possibly stay away from all the mad volatility hitting next week. I'm expecting on the break of these levels to rapidly see the 83 handle. And if you're continuously breaking below these levels, I even like to see 82 handle. But early in the week, I'm quite keen to see 83.80s hold, and then possibly most squeeze we should get 84.50. If we still stay around these levels, I'm really interested to start attacking the 83 level to see what I can get out of that trade early in the week. We have some NZD data as well to spark volatility, so I'll be using those events and that sort of direction. Then we have the big Fed statement and Federal Reserve. To the run up to it, so Wednesday morning, expect market to be dead, expect market to do some random nonsense, and on Thursday, expect it to reverse it. So I'm going to show you the last couple of meetings, and I don't want to drag this video out too long, but I'm going to show you the last couple of meetings and how it all panned out for some USD pairs. So last meeting was 16th of March, then it was 26th of January, and we had 15th of December. I'm going to try the November one as well, just to really show you that pattern emerging. And one of the particular pairs we'll be looking at is GBUSD, where that pattern seems to come across quite a lot. Even on most other pairs it happens, but GBUSD, I've ran some stats, and it shows over 80% GBUSD reverses course the day after the Fed meeting. So for instance, the Fed meeting comes, GBUSD pukes, and the next 2 days, it just really undoes the entire meeting. The only time this doesn't happen is when the Fed comes up with some new information and starts to pivot. We're not expecting to pivot on anything. Next week, they're just expected to do an interest rate hike and lay out a path, which won't be necessarily anything different. We know the hiking rates. It's just a matter of how much they're going to hike. So I'm going to take you down to a couple of last few meetings. One is the 16th of March, just to see how the patterns worked out, if you saw those reversals. So 16th of March on GBUSD, we were trading around here. So you can already see a rational candle here on the 16th of March, a ping down, a rally, and not long after we saw this entire thing come back down. So actually was the following day. So we had on the interest rate meeting itself, it puked 43 pips. It went up 122 pips, and from that peak, it started closing that rally gap again, which was 124 pips. So that's the sort of a move we're looking at going post Wednesday meeting. So I'm not saying we want to be trading the meeting itself. What I'm saying is we want to be trading the reversal. So you tend to see a movement like that back into here to fill the entire range. Sometimes what you tend to see, what we see this time, you see actually a bigger move materialize where it just starts a new trend lower altogether. But that's a little bit more difficult to catch with in regards to timing. But this usually tends to play out about 24 to 48 hours after the meeting happened itself. So that was the March meeting. Let's have a quick look at what happened in 26th of January. So 26th of January, we had, again, this price action evolved. The next day, we around New York time, once we came online, did you see what GBUSD did? It started to close that rally again for the better part of 130 odd pips. We go back to last year, 15th of December. 15th of December, usually December, the price movements are very, very tight. You might not see these huge, bigger moves that you're expecting, but again, more or less, we had something similar. So there was an interest rate meeting. We saw a rally. The next day, around a New York session again, we found a top. And guess what? Before you know it, without any news and any new information, we saw a peak of 170 pips before market did its own thing. And the meeting before, I don't really want to carry on too much, but you get to see the patterns. That's a sort of a pattern you want to trade after the Fed meeting. Instead of getting too excited, what does the Fed meeting itself do? Try to trade what happens after that. And unless there's any new news, which usually is unlikely, you don't tend to see a lot of you tend to see these reversals. So here on the 3rd of November was a really smaller one. This whole thing played out pretty much overnight. So we saw a rally, and then we saw market eat up the entire move again, and then we had another more damaging move after that. But more or less, you get to see the pattern that plays out after the Fed meeting. So that's something you can incorporate in your trading plan for next week, or for basically Thursday trading, especially as we will have the Bank of England. They're expected to hike rates again, but they're sort of doing these dovish hikes, which means they're not really aggressively trying to, how to put it, they're not aggressively trying to push the range out too much, because UK economy is expected to slow down for the rest of the year, which is getting traders excited of selling pound, which could be something that we could get into next week. There's not a lot of levels right now. China has been pretty much destroyed every important level on the downside. But coming Thursday, depending on what the Fed did, if you see a rally, I'll be interested to sell into it. And to one, play out the pattern, two, to also play the dovish Bank of England and possibly capture lower levels. Again, it would be something that we will play based on mid. The only trade that I like to play on levels is possibly NZD-JPY to just capture maybe 100 pip move or so. Nothing too much. And with all the other currencies, because they have central bank meetings active, we have to play it a little bit safe and just wait for volatility to come and pass, and then take up a trade much safer. And let's see what else we have on the calendar. Moving into Friday. We'll have the all-important NFP, which is rarely ever a trend changer, but we're going to have some spark of volatility. Bear in mind, once you come online Friday morning, you don't want to get too excited about trading. Wednesday morning and Friday morning will be sessions which is going to be extremely slow, extremely choppy, and you don't want to take in big swing trades expected to go anywhere. It's really important to keep that in mind, because it can save a lot of mental capital when you stay out of these markets, as they won't be kind to our type of trading. And then post NFP, I'm going to have another live session to see, or possibly in the morning, to see what's the best thing to capture in that environment. Again, next week, a lot of moving parts. We don't want to front run any of them. I'm keen on seeing if I can catch a downside on NZD-JPY quite early in the week, and then everything else is open to interpretation as we move on in the week. One important thing I like to talk about is, before we move to the psychological note, is indices. So in specific S&P 500, right now the S&P 500 is quite down, obviously. And if I also look at the other chart and bring up the VIX for you, you can see that the VIX is quite elevated as well. So let's see if I can find it here on my watch list. There they are. The volatility index is showing quite some elevated levels, and you can see that's reflected in S&P 500. Going forward, we're not expecting volatility to come crashing down. What we're really waiting for is to see what the Fed does and what the market reaction will be to the tightening, how aggressive they will be with the interest rate hike path, and if market starts pricing in 75 basis point hikes, that will be very different. In any other case, I am on indices going into next week. I am not particularly bullish, because we're not expecting volatility to come down. That's pretty much given at this point. Market is protecting itself, and market participants are moving to cash, hedging, and they're expecting the volatility to die down anytime soon. That means S&P 500 just continue to stay a bit lower or continue getting hurt, which more or less causes a risk-off scenario, which tends to be bullish USD as well, mind you. That's all I wanted to cover this week. There's going to be another video tomorrow, specifically because market is going to be half open, because UK is shut for holidays. So I'd like to have another review once market comes online tomorrow, just to really add a bit more flavor to our thought process, see what the macro drivers are. Big picture, nothing has changed since February. Pretty much the game in town is still USD, and that's the direction we are playing it just now. There's a couple of articles I will go through just real quick, and then we can wrap up this session. The first thing I wanted to show you is US real yields started moving towards positive territory again. You may or may not know, US real yields, specifically I'm looking at a 10-year benchmark, is got an inverse correlation with gold. So as it goes more negative, gold goes up. As it goes more positive, gold goes down. And looking at that, you can see the reflection in gold last week as well. So you can see that gold had some bearish reaction last week, specifically going to Thursday and Friday. And we are expecting this to continue more or less. I should say that I'm not entirely sure. Let me bring up this data. I'm not entirely sure if these levels will hold, because last time we traded near to that, or about zero, was around here, and very quickly we came back down. I think it would make more sense if you could see it on the chart, but if you're a data guy like myself, these all make sense. You already can see the trend. There was a downtrend, uptrend, hit the zero level, bounce back down, and now it's knocking above the zero level. And it's really have to wait and see if this will hold. If it doesn't hold, you can automatically assume that these levels going to get rejected and we're going to see more upside. But if we see real yields moving more into positive territory, there's little to love about gold. And that's something you want to incorporate in your thought process when you're trading commodities, in specific gold. Then we move on to Danske research, where they are saying that the regime shift in Asia bodes well for broad USD strength. My article goes back to the 26th of April, which I believe is just about 3-4 days ago. Basically, they're saying that the shift from the Asian currency and the Asian markets like Japan, because they are losing out on trade because of higher commodity prices, and Japan and China are net energy importers, where United States is quite a big exporter in energy. USD tends to benefit from that. And as you can already see, big picture, USDC and Edge has moved up quite dramatically. And that there's got some correlation overall USD strength, though you could see that in other currencies as well. So that's the wrong chart, USDC. So that's a USD yuan. Basically, that's what I explained. Now, a lot of the move has already happened, mostly on the back of People Bank of China cutting rates. But big picture, it's likely to continue the whole trend of USD strength, and it's not abating. This is really what this article is trying to say. And let's see one of the key movers for next week based on what Danske Bank says. I always like to check 1 or 2 banks to get a feel for things and see if there's maybe something we missed out. So the Russian-Ukraine war entered its 3rd month without any signs of the conflict being resolved. Global growth concerns how we can hit the market. Assets tend to trade closely in tandem with cyclical output performance, and market volatility has increased. Yes, that's something we picked up on the VIX. So Russia halted gas deliveries to Poland, Bulgaria. Market concerns have amplified COVID and USD strength. The NY has seen sharpest decline. USD fell to lowest level. And dovish policy, Bank of Japan has jolted USD JPY by higher again. Risk Bank, incumbent French president, 5-year with vote, 59% votes. A busy week of rates market. US for FOMC meeting on Wednesdays in highlight. 50 basis point hike. NFP expecting 400K. All right, nothing. And emergency meeting among EU and energy ministers is scheduled for Monday. Something to keep an eye on. I didn't know that. Euro area, we focus on. So really, Euro area is about Russian energy supplies. If out of that emergency meeting, they're going to decide, look, we cut all ties with Russia, no more energy from them, that's obviously not good for Euro. You can expect a recession very, very quickly. So definitely on Monday, watching how Euro will react and what the mood is. But certainly, I can expect some traders expecting want to front run the outcome of the outcome of those talks. And if it's me, I would probably short as well. So based reading on that short snippet, I can expect some bearishness coming at EURUSD. I really like this Friday rally to close, because the Friday rally was really based on just some Chinese comments. I'm not expecting this to hold Monday trading. I'd really like to get this resolved to the downside. Plus, on top of that, we just see that there's an energy meetup between EU leaders. I can't expect them to come up with some positive that's going to be in favor of Russia. It's going to be some negative. And it's like one of those, you have to slash their own wrist once, slash Russia twice. It's an old saying. in a very different country. I don't know why I brought it up. But generally, I'm really expecting this to be resolved to the downside, just based on these two factors. One, the thing that drove it higher was really some Chinese comments, had not a lot of positive effects for the euro. On top of that, the energy meeting could possibly be some negative for euro area, and that's just more reason to expect a sell-off intraday to at least go back to these levels under the 1.05 level, I should say. Let's see what else we've got on the docket for next week. So we've read that. Let's just close this. I'm not going over the same article twice. That's about that. SCB, focus on central bank, payroll data, attractive workers, back for the slowdown, slight more growth rate, but not enough to concern wage inflation, Swedish PMI, and European data is mostly second tier this week. FOMC Wednesday, 7 FS median projection market pricing. Further decline in Swedish PMIs. Something interesting, by the way, I should point out, since I never look at Swedish data too much, but Swedish PMIs is religiously one of the best way of determining what Euro PMIs will be. Honestly, it's incredible. First time, who was that? There was an analyst from Northwest Bank, I think. It was Steno Larsen. You might know about him. He recently left the bank. It was Steno Larsen who pointed out, I think 2016, something like that. He said the Swedish PMI are the canary in the gold mine for, sorry, in the coal mine for Euro PMIs. So it's usually a leading indicator where Euro PMIs are heading. If Euro PMIs are heading lower in line with the further decline Swedish PMIs, you can also expect some more. Again, there's not a lot to love about Euro, so some more pressures. That's all I wanted to cover about what the data is and what the trades are for next week. But let's talk about something very different. Let's talk about how to trade drawdowns. That's one of my niche things I do all the time, specifically when I see like a losing trade, or when I see a couple of losing trades on my P&L, and I use this strategy to get out of the thought process psychologically, right? Let's say you've got a modest account of about 100,000. Here the currency is euro, it could be any currency you have. And based on my longer term trading, I know that my win probability doesn't fall below 60%. So I'm going to go for the lowest payout, for the worst trading conditions. I'm going to, based on my strategies and the way I've traded, it doesn't tend to drop below 60% win probability. And you might find that over your own trading as well. So when you steadily look up what your trades were, and don't look at your P&L, because your P&L might have moved dramatically based on how you've moved your risk percentage. Let's just stick to the whole idea of how many pips you've made and how much you've risked. So you want to look at the risk reward. That means that if you go through your old trading history, you can't look at your P&L and determine if you were profitable. You actually have to look at every single trade and see what the win to lose ratio was and how well you fared. You get an idea of what the worst or your best win ratio is going to be over a longer period of time. And if you go based on a 1 RR, so sometimes my RR changes. Sometimes I have a 0.5 R. That means I'm risking 2% to make 1. Sometimes I'm risking 0.5% to make 4. So it changes all the time. But if majority of my trades, they usually work on a 1 RR basis. So I know that about my own trading, about your trading. You can figure it out very quickly when you have a quick look over your own trading history. Now, why am I saying this? Because I'm going to building up this narrative for you where you can understand how you need to get out of where you are in your trading drawdown once you have these sort of data. And let's say number of trades 100, which for me 100 trades will probably be the better part of 2 to 3 months. Number of lines will determine how many iterations of these you're going to run through. It's just really give us a broader view of how your trading portfolio could evolve. And our risk per trade about 1%, which is something we can play with, but that's not going to determine how we trade out of a drawdown. I'm going to start this simulation, and I want to show you something, a technique I use to get out of drawdowns. This trading simulation has got 20 different lines based on these iterations we showed and how differently it could play out. The black line will show you the median. So the median tells you that the average max drawdown should have been about 6.5% over 100 trades. Your biggest drawdown was about 11%. and minimum max equity you can see here. So you got great expectations here, not too bad. It gives you also Kelly, means how you should probably play around with the risk percentage if you want to play with it a bit differently. But all in all, it gives you some really good, important data. Why? Because, for instance, if you're trading in your drawdown, in your, for instance, this green line here, based on your data, you know you're pretty close to the bottom pain you can experience as you will be trading for a longer period of time. Only a few handles of these. You see, only one or two. Actually, only one of them actually ended up in the long term in a loss. That's based on a very, very low impact strategy, low risk percentage, win to loss ratio extremely moderate, and win probability extremely moderate as well. And I use this all the time. So when I'm in a bad spurt of trades, and for instance, I'm somewhere here below where I started the month, I can remind myself, look, based on my strategies and based on what long-term effects are, it doesn't matter where this ends up. I end up in a profit anyway. I just have to continue doing what I'm doing. And it's really important to remind yourself that. When everybody talks about it, you see motivational videos like trade harder, work harder, be smarter, do stupid stuff, do like new strategies when you're in the middle of a drawdown, all that nonsense. They never work. It never worked for me, and I don't know ever work for anyone else. So in the middle of a drawdown, change strategy, and all of a sudden your trading, it goes in a new direction. I never see it happen, and I doubt it's going to happen for anyone else. So whenever in a drawdown, bring up this equity curve simulator. I've used just a random web page I've searched before this video. I'm sure there's many others. And just draw out what your history tells you about your own trading, so you can get out of your own mind, get out of the own fear in your head, and start engaging market from a statistical point, where you can trade yourself out of drawdowns and make some decent profit for yourself in the long term. Again, for you winning in trading, it's not going to be every trade, it's not going to be every week. It's going to be what you do when the trading gets tougher with the long term. And tools like that can help you immensely stay back on track, specifically when you're on the fence about changing strategy or making things different, or not taking trades or taking extra trades. Tools like that will keep you right. And in my experience, when the trading gets tough and you grow and learn from it, that's when you're one step closer to where you want to be in your trading career. But when the trading gets tough and you do stupid decisions, you have to go back and do everything again until you come to that point where trading gets tough for you, where you're ready to be molded into something better out of yourself. So use that tool to your advantage when you're in a drawdown. Use it to help you psychologically, so you can have hope again and push through bad periods, because that's where you grow. You don't grow any other time. Okay, that's what I really wanted to say and drive home in terms of what psychology is. If you're interested in how I trade and what I trade, and the winners I take and the losers I take sometimes as well, head over to speculativestrading.com. Right now, I do offer where you can actually join the trading room for extremely low price. For a full month, you get access to all of that. You get access to live sessions on a throughout the week, the trades I discuss, why they move the way they move, and also how we navigate markets based on macro data and some fundamentals. It's a really great environment, some really great traders in the room as well. Everybody helps the other out. We built this really nice community over the past nearly 5 years. And I'm really looking forward to invite a lot of you in there if you're interested to join. Again, that's all I wanted to cover this week. I wish you a very successful week and very profitable as well. Thank you very much, and bye.